Hi there. Moving from sole trader to limited company status can offer benefits, but ownership structures need careful planning.
Picture this. You've built a fantastic business, you're a highly profitable UK sole trader pulling in over £60,000 a year, and you're thinking, right, it's time to incorporate. It sounds simple enough, doesn't it? Well, welcome to this explainer. Today, we're unpacking some absolutely crucial research prepared by Atlas Tax Advisors, or ATA, a premier UK accounting firm that specializes in making sense of HMRC's complex rulebook. Their latest report is called The Corporate Holding Trap: Transitioning to a Limited Company in 2026-27. We're going to break down exactly why switching your business structure isn't just a quick paperwork exercise anymore, and why doing it without expert guidance could cost you dearly.
Okay, let's dive right into this. Why on earth would you give HMRC up to 45% of your hard-earned income when you could be paying a much lower rate? It's a very common compliance situation, and frankly, it's a massive pain point for hardworking British business owners. You're pouring all hours into your enterprise, but personal income tax and national insurance are just aggressively eating away at your profits. Once you hit that $60,000 to $100,000 bracket, the tax friction becomes incredibly heavy. Honestly, staying a sole trader starts to feel a bit punishing.
So the motivation to switch is obvious. On one side, we've got the heavy burden of sole trader income tax, which, as you know, can reach up to 45% for additional rate taxpayers. On the other side, the limited company corporation tax rate sits much lower, currently scaling between 19 and 25%. This rate shift is the main lure for incorporating. It's a great way to keep more capital in your pocket to reinvest in the business, but you have to be incredibly careful here. While it looks fantastic on paper, this exact tax appeal acts as bait for a much larger, hidden compliance trap lying in wait for the 2026 and 2027 tax years.
To keep you safe, here's our roadmap for today's explainer. 1. The lure of incorporation. 2. The capital gains trap. 3. The Section 162 minefield. 4. Property and debtor problems. 5. The goodwill paradox. And finally, planning your 2026 transition. Let's get moving.
Right, on to Section 2, the capital gains trap and the cost of a paper sale.
You see, moving your business into a limited company isn't viewed by HMRC as just a simple name change or a switch of your bank accounts. In the taxman's eyes, you are actively selling your business to yourself, or specifically to your new company, at full market value. And selling assets at market value instantly triggers capital gains. That brings us to a really critical number, 18%. This is the new Business Asset Disposal Relief, or BADR rate, coming into effect from April 2026. The cost of getting an incorporation wrong has literally never been higher. Imagine you've built a business worth £500,000. Under these new rules, moving that into a limited company improperly could trigger a $90,000 tax bill out of thin air. You could owe HMRC hundreds of thousands of pounds before your new company has even opened its doors.
To avoid that absolute disaster, we rely on a primary shield called incorporation relief, which falls under Section 162. This is something many taxpayers first discover when reviewing their tax position with an advisor. It's essentially a mechanism to defer that capital gains tax by rolling the gain on your business assets into the base cost of your new company shares. Think of it as hitting the pause button on that massive 18% tax hit. You don't pay the tax today. Instead, you defer it until the day you eventually sell the shares in your new limited company.
Section 3, the Section 162 minefield, and navigating the golden rules.
But don't celebrate just yet. Navigating the rules of this relief is incredibly strict. Stepping out of line is quite literally like stepping on a compliance landmine. To use this relief, you are bound by 3 really rigid rules. Rule 1, the business must be transferred as a going concern, meaning it's active, operational, and seamlessly continues trading. Rule 2, it must be exchanged wholly or partly for shares in the new company. And Rule 3, all assets except cash must be transferred. Here's the major danger. From April 2026, this relief is no longer just an automatic given. You've got to actively claim it on a self-assessment return with full, detailed tax computations. If you fail even one of these 3 tests, your tax shield drops instantly, and that 18% bill becomes payable immediately.
Let's move into Section 4, property and debtor problems and the all assets trap.
Let's look at how this actually works in practice. That strict all assets requirement we just talked about is exactly where most incorporations fail. By law, you can keep your cash out of the transfer without breaking the rules. That stays in your personal pocket. But property and debtors absolutely must be transferred. A lot of people overlook this detail, particularly when it comes to real estate. Property owners often try to hold back a commercial building from the new company to dodge a nasty stamp duty land tax bill, which can easily run it to tens of thousands of pounds. But doing so breaks the all assets rule and completely detonates your entire capital gains deferral. You basically trade a stamp duty saving for a devastating capital gains hit.
The experts at Atlas Tax Advisors have a great professional tip for this. You cannot pick and choose which assets to transfer if you want Section 162 relief. And keep in mind, this also includes your outstanding debtors, the money your customers currently owe you as a sole trader. If your new company simply collects your old sole trader debts and then you draw that cash out as income, you are going to face double taxation. You pay tax on that invoice when you build it as a sole trader, and you'll pay tax again drawing it from the company. It's a tricky trap that requires flawless asset management to avoid.
This takes us to Section 5, the goodwill paradox, and creating a tax-free debt.
Now we're getting into an advanced tax strategy for extracting your future profits efficiently. First off, what exactly is goodwill? Simply put, it's the intangible value of your business above its physical assets. We're talking about things like your brand name, your loyal customer base, and that stellar reputation you've built up over the years. Highly profitable sole traders often build significant goodwill. It's what makes your business worth buying in the first place. And here is the fascinating part. That goodwill can actually be sold to your new limited company, which opens up a very unique planning opportunity.
The strategy here is brilliantly counterintuitive. Step 1, you deliberately elect out of your Section 162 relief. Step 2, you intentionally pay the 18% Bader tax on the goodwill right now. I know, why on earth would you do that? Well, let's use a quick example. If your goodwill is valued at £100,000, you pay an £18,000 tax bill today. But because of Step 3, you create a director's loan account, or a DLA, for the full £100,000 value of that goodwill, which leads directly to Step 4. You can now draw that £100,000 completely tax-free in the future, because the company is simply repaying a debt it owes to you. It's a real paradox. You pay a little tax now to extract a massive amount of cash tax-free later on.
But what if you absolutely must keep your property out of the company? Well, you have to carefully weigh up your deferral options. As we can see here, if you use Section 162 incorporation relief, you must transfer all assets, and creating that powerful director's loan account is heavily restricted. However, Section 165 gift relief acts differently. This allows you to defer gains into the company's assets and selectively keep your property out. But a word of warning, Section 165 carries a high risk of double taxation down the line. If the company ever sells those assets, the company pays corporation tax on the gain, and then you pay income tax or dividend tax to actually get that money out. It really requires looking years into the future.
Did you know selling personal goodwill to create a director's loan account is heavily restricted by HMRC's anti-avoidance rules? You can't just make up a high number to extract more tax-free cash. Getting the valuation wrong can trigger some pretty severe penalties. HMRC's AI-driven tax system now actively scans and flags overvalued goodwill for immediate investigation. You absolutely need robust HMRC-proof valuations prepared by professionals to survive an inquiry and keep that tax shield completely intact.
Let's wrap things up with Section 6, planning your 2026 transition and structuring for success.
Because how you set up your limited company today directly dictates how you can exit or extract your wealth tomorrow. When structuring for the future, you really must memorize this number, £25,000. This is the crucial reserve threshold. If you ever want to close down your company, maybe you want to retire or start a brand new venture and extract the cash, any corporate distributions over £25,000 require a formal liquidation process, specifically a member's voluntary liquidation, or MVL. Without an MVL, HMRC will tax a $50,000 distribution, for example, as standard dividend income, hitting you with a massive income tax bill. With an MVL, that cash extraction is treated as capital, allowing you to access much lower capital gains rates. How you structure your initial incorporation completely dictates whether this MVL exit route will even be a viable option for you later on.
So the crucial takeaway is this: the corporate holding trap is very real, and the stakes are exceptionally high for sole traders making this jump. Lower corporation tax is undeniably appealing, but the incoming shift to an 18% BADR rate, the incredibly strict Section 162 all assets rule, and the complex goodwill valuation traps mean you really cannot do this alone. Transitioning in 2026-27 is no longer a simple automatic process where you just file a couple of forms online. It requires proactive, bulletproof structuring to ensure you actually keep the wealth you are working so incredibly hard to build.
If you are planning to incorporate, please don't leave your financial future to chance. Get in touch with Atlas Tax Advisors, ATA, today for a bespoke 2026/27 incorporation feasibility study. They can help you navigate these complex traps safely, legally, and effectively. Please remember, this explainer is for general guidance only, and you should always obtain professional advice before making any financial decisions. So, I'll leave you with this provocative thought. As the tax landscape shifts beneath us, is your current transition plan truly HMRC-proof, or are you walking straight into the corporate holding trap?